We are joined by Charles Payne, making money from Fox Business. Charles, good morning.
Good morning.
Morning.
Let's get right into it. When we look at what's happened in the market, we had a bear market, and now it feels like we're back in a bull market. Lay out what you see right now as this current market environment.
It is amazing because leading up to all of this and the psychology of it all, to me, is what's been so fascinating. And you see it in a lot of these sentiment reports where they'll say, the folks who take these surveys say, unspontaneously, right, that, hey, I've never heard this much negativity about any sort of administration ever. Right, so the stage was set for any kind of potential overreaction to anything that was seen negative or deemed negative. And of course, that's why the soft data, hard data divide has never been as great as it is right now. Because on one hand, everyone's been told it's the end of the world. And yet, ironically, and I haven't looked this morning with the update from the AAII sentiment, it's updated every Thursday, but record amount of bearishness there, but by the same token, a record amount of retail buying the market. On the other hand, Wall Street, just, every single day pounding away. It's going to get hurt. Everyone's going to get killed. Everyone's going to crash. And so, of course, the exact opposite has happened. But now we've got this little bit of a lull, right? Because this has been a heck of a rebound. One that's made the charts, right? You got Stevie Cohen out. You still Chanos is always out. You got another guy out. And last week, I think they had Paul Tudor Jones on CNBC. So again, the smartest folks in the room are sort of doubling down on this, the worst ever narrative. And on the other side, the retail, the public is saying, well, you taught us to buy on weakness, and we just don't necessarily believe it's going to be as bad as you say. Enter today. Walmart's already reported good numbers for them. They more or less beat across the board. And they're suggesting, well, you'll see higher prices maybe later this month and in June. The real point, though, is you can raise your prices. In this economic environment, the point is, can someone pay it? Will the public be able to pay it? Someone who walks in Walmart with $100 only has $100 to spend. So if they were going to buy two items for $50 each and one costs $60, more or less, they'll buy one item and leave the store. So I just think it's fascinating. I heard also the conversation about, of all of these data points, which one is the most important? I guess it depends on where they come in, right? Initial jobless claims over 250 makes it super duper important. These manufacturing sentiment numbers have really been amazing. The only good news has been maybe some sort of improvement lately on the employment side, but also, of course, rocketing prices paid. We want to see that stall, or at least, I don't know if it's too much to ask that they pull back. So I think the importance really depends on how they come in, right? If they come in significantly off consensus, that changes the ranking.
Got it. And before we get to Tracy, because I know she's got some questions for you as well. We've got a lot of questions for you this morning, Charles. It's so great to have you here.
I'm not.
I want to talk about the bond market. Yeah. Well, this is a tough one. So here's the thing. You see everyone now talking about the bond market. The bond market, the futures market continues to dip lower, which indicates higher rates, especially on the long end. The 30-year can't seem to hold any rally. You consistently see people say, at some point, stocks are going to start looking at bonds. Stock market saying, yeah, that's not really correct because we're not recognizing it yet. What do you think about the bond market, and does it at some point have an impact on stock prices?
It historically has. I mean, the bond market's considered the so-called canary in the mine, but the debate is really over why are bonds acting this way. Jim Grant is one of my favorite guests to have on periodically. I need a format like this, honestly, though, right? Because he's so long-winded, but you want to hear everything he's got to say. And he's already predicted a secular bear market in bonds. And I happen to agree with him. We had a 40-year ride where we had a great 40-year run, but pull the chart back a little bit further than that, we had a 40-year bear market. So we had a 40-year bear market, a 40-year bull market. I think he might be right. You look at our debt and deficits, and one of the things that you're seeing a lot is that, well, there's no appetite for our debt, right? No foreign appetite for our debt. One of the charts I'm probably going to use on my show today will show, okay, foreign ownership is up. It's been mostly Japan and China that's gone down, but there's been a substitute for it. Real soon, the UK will own more of our debt than China, at least directly. I don't know what they own through the Cayman Islands. And so I'm not sure if that's it. The role of the Fed, obviously you've got QT, but they also have shown up on recent bond auctions, right? So that's kind of odd and weird. Or is it a reflection of the economy? I think one of the reasons it hasn't really had a direct impact on the stock market yet, is that there's still a debate on why yields are up right now. And if it's just one of these things where structurally it's going to go up, regardless of some of the traditional reasons, then maybe the the stock market doesn't necessarily have to follow the bond market.
Do you think that, and it does look to me like yields are going to continue to rise, when does this become a problem? We know Besant has said that he wants yields down. So
Yeah.
do we get some sort of intervention from the Treasury, or when does it become important to them?
There's no doubt about it, but he doesn't want to panic either, you know? Up until a few days ago, after that last scare, when we got like 4, 5, whatever it was on the 10-year, we were making a series of lower highs, right? So we dip, go back, and that's the kind of thing you guys, are big chartists and technicians. So that was feeling pretty good for a moment. I think maybe Besson wants to see how all the markets react to maybe the announcement of a couple of deals. Yeah, I also heard talking about the scuttlebutt with India. Yeah, I think they, the street really now they just want to see the deals, not anymore sort of talk or hints or whatever. And if you can get Japan and South Korea and perhaps even India. So Besson doesn't want to intervene, but there's no doubt about it that he will. In the meantime, you'll continue to get the public bludgeoning Jay Powell from Donald Trump on this. But, more and more people on the street, though, are agreeing with President Trump that, that maybe Jay Powell is making a mistake here.
Yeah. Well, we're about a minute to data. And like we talked about this morning, and you mentioned, Charles, we will be going over that data, and we'll come to you and Tracy for, immediate reactions from it. Shai, we've got just under a minute, maybe a quick preview of what we're looking at in terms of what expectations are for let's go over the three big ones.
So initial jobless claims, 228 is the survey. Continuing claims at 1.890 million, which neither of those are far off from what they have been. Philadelphia Fed, minus 11. Prior was minus 26.4. We also have PI, of course, all important. Month over month is expected at 0.3%. Prior was minus 0.1%. So expected a little bit higher. And year over year, expected is 2.5.
All right. That data should be hitting the wire just about now. Wait for Tracy to get it in. Then we'll go to you, Charles, and some immediate reactions.
Okay.
We've got about a few seconds left.
All we do. Yeah. So I think the main thing that we'll talk about when we see this, I think that traders are going to be keeping an eye on is what is the bond market doing and how, if at all, significant of a move you see and how that immediately impacts stocks. I mean, that's the one thing I would say that I will be watching this morning, because that's the one thing, Charles, that I look at is if rates keep grinding higher, I don't think that is as big of a deal, because the market seems to always be able to deal with anything in stride. It's when things happen quickly. If rates were to go up quickly, and like you said, what's the reason they went up? That's where I think it matters. And this data, maybe one way or the other, sways that today, maybe just a little bit. And Shai, the first one we'll probably be going over is what, PPI?
New York State came in first at minus 9.2. We have PPI 3.1% year over year, month over month minus 0.4%. So much cooler on that. Jobless claims came in at 230. So in line. Continuing claims 1.881 million in line again. And we had Philadelphia Fed at minus 4.0. Expected was minus 11.
So minimal impact on equities. We'll go to you, Charles. Bonds bounced a little bit. Really kind of nothing. Very minimal reactions. Thoughts on the data?
Yeah, it is. So far, it's like a real nothing burger. I guess this might be a digesting this, but what stands out to me the most, obviously, is this month over month on the PPI, right? And again, Walmart came out today and saying, hey, the prices are start going up later this month and in June. So to a degree, maybe that set the tone that these numbers are, again, quote unquote, irrelevant. But we know that, the headlines were saying even back in March that we should be feeling this stuff immediately. And so some of it should be showing in the data, and still it hasn't. So it's really, okay, let's see. Yeah, it's really pretty impressive. So I guess was the PPI. What do you have for that? That came in a little hotter, right? On the
year over year, a little bit hotter and much colder on the month over month.
Okay. Well, right now,
I mean, they're still both.
Yeah.
Yeah.
And markets are feeling that way. I mean, again, the initial thought was for me, look at the 30-year, see what it did. You had a bounce only to come right back where it did. Markets really not doing much at all. Charles, we haven't talked about gold. We've only got you for a couple minutes left. We have to talk about gold with Charles.
Gotta talk about gold.
Tracy has been really unbelievable at covering all of what's been happening with gold along this entire way and talking about the demand that is there, the buying for gold. Gold has now kind of had a double top. It's now come off. What are your thoughts about gold and where it stands in this market environment?
Yeah, short term, I think particularly technically, it looks like it's at that point where it probably will pull back just a little bit. Even when we look at the historical ratio to silver and some of the other things, we know China, there was a big question mark on how much more China was going to buy. Then we found out late, I think it was last week, that for the 6th month in a row that they were major buyers. And the geopolitical stuff, particularly on the economic side, you start to add in this economic trade battle and the end of American exceptionalism narrative, I think also played a pretty big role in gold. So, my position has always been you have to own gold, a certain portion of your portfolio. And, I've never been a short-term person with respect to gold, but a lot of people have called in looking for this move to continue. And so I think we get a short pullback, nothing consequential, and then I think it resumes the move higher.
100% agree. We talked about that a little bit earlier today, which would be fine. A little bit of air out of this market, I think, is appropriate, and I don't think it's going to scare anyone. And I think dips are going to just continue to be bought. This one just might be a little bit deeper than, what we have been seeing in that $250 pullback range. We make it a little bit more, 500, 600, but it's still that market's going to get bought at those levels.
Yeah.
No, I was just going to say thanks for inviting me.
Yeah, Charles, it's been a pleasure.
Welcome back anytime.
Okay, cool. See you guys later. Thank you.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.